Index investing. 7 key takeaways. Today we identify 7 things you need to know about index investing and tell the story of Sarah, a savvy investor who believed in the simplicity and effectiveness of index investing. Here we go. Index investing, also known as passive investing, involves constructing an investment portfolio that closely mirrors the performance of a particular market index, such as the S&P 500, Nasdaq Composite, Dow Jones Industrial Average, or NSE Index. Here are 7 things you need to know about index investing. 1. Benchmark tracking. Index investors aim to replicate the performance of a specific market index by investing in a diversified set of securities that closely mimic the index's composition. This approach seeks to match the returns of the overall market rather than trying to outperform it. 2. Diversification. By investing in an index fund or exchange-traded fund (ETF) that tracks a broad market index, investors achieve instant diversification across multiple stocks or assets within that index. This diversification helps spread risk across various sectors and companies. 3. Low-cost strategy. Index investing generally involves lower fees and expenses compared to actively managed funds. Since the goal is to mirror an index's performance rather than actively pick stocks, management fees are typically lower, reducing the overall cost for investors. 4. Market efficiency. Index investing operates under the belief that markets are generally efficient and that trying to consistently outperform the market through active stock selection or market timing is challenging, if not impossible, over the long term. 5. Passive approach. Index investors take a hands-off, passive approach to investing. They don't actively buy or sell stocks based on market conditions, economic forecasts, or individual company performance. Instead, they buy and hold the securities in the index fund, only making adjustments to reflect changes in the index's composition. 6. Suitability for long-term investors. Index investing is particularly suited for long-term investors seeking steady, reliable returns over time without the need for constant monitoring or frequent portfolio adjustments. 7. Broad market exposure. Investors gain exposure to the entire market or a specific sector without the need for extensive research or stock picking. This approach is especially beneficial for those looking for simplicity in their investment strategy. Practical examples of index investing include purchasing ETFs or mutual funds that replicate the performance of well-known indices like the S&P 500. Investors who opt for index investing aim to match the market's returns rather than trying to beat it, emphasizing consistency and stability in their investment approach. Overall, index investing provides a straightforward and cost-effective way for investors to gain exposure to the overall market or specific sectors while minimizing costs, reducing the need for active management, and benefiting from diversification. Let us now talk about Sarah, a savvy investor who believed in the simplicity and effectiveness of index investing. Sarah was a practical and goal-oriented woman living in a suburban area named Brookside. She had a keen interest in investing but preferred a straightforward approach that didn't involve constantly monitoring individual stocks. Unlike some investors who spent time analyzing and picking individual stocks, Sarah was drawn to index investing. It was a strategy that involved investing in a broad market index, like the S&P 500, which represented a diversified basket of stocks. In Brookside, amidst discussions about market fluctuations and individual stock picks, Sarah focused on the reliability and long-term benefits of index investing. She understood that by investing in an index fund, she was essentially buying a small piece of the entire market. One day, while contemplating her investment strategy, Sarah decided to allocate a portion of her portfolio to an S&P 500 index fund. She appreciated the simplicity and stability it offered compared to the complexities of individual stock selection. As time passed, the market fluctuated, and individual stocks experienced ups and downs. However, Sarah's index fund mirrored the overall market performance. She didn't worry about the volatility of individual stocks because her investment was spread across a diversified index. While some investors attempted to beat the market by picking specific stocks, Sarah's index investing approach provided her with consistent and reliable returns, closely mirroring the market's performance. Sarah's success story quietly resonated in Brookside, catching the attention of fellow investors. She showed them that index investing wasn't about chasing hot stocks or trying to outsmart the market. It was about embracing a passive, low-cost strategy that offered diversification and stability. Through her journey, Sarah taught the community that index investing was a prudent way to participate in the market's growth without the stress of constantly managing a portfolio. It was about staying invested for the long term, benefiting from the market's overall upward trend, and achieving financial goals through simplicity and consistency. Thank you for watching.